Alright, so let's see how we account for it if it's a sales-leaseback arrangement where we actually use the sales-leaseback approach. In other words, it would be an operating lease after that point. Now, if you originally downloaded this handout, the very first file, when I pulled these problems from Connect, I realized when I was recording this video, or right before when I was working the solution, before I recorded this video, let me rephrase, that the situation in which they presented in the algorithmic problems in Connect created a lease that would not be an operating lease. It would actually be a financing lease, which would go back to the financing arrangement, even though it has a sales leaseback. So if your situation creates that, just ignore it and go with the fact that it says operating lease. What happened is we used 100% of the remaining useful life. Therefore, it would be a financing lease. Also, the present value of the lease payments exceeded the fair value. Therefore, it would be a financing lease. So in the original version, if you still have that, what you'll see here is a $220,000 payment. When they were creating the algorithmic versions of this problem, they didn't pay attention to the fact that that creates a different situation than what they're describing. So I rewrote the problem a little bit. So if you have the original downloaded, you may need to re-download just this problem. This is the only one that changed, but I didn't want it to be an unrealistic situation where you're actually creating a finance lease when they're calling it operating lease. So I changed the numbers just slightly so that would not be the case, okay? So re-download for this problem, or just open the new one and then copy this into your file so that you have the $96,000 payment instead of the $220,000 payment. It just didn't make sense to have that payment because it created a totally different situation than what they were trying to achieve. Alright, so let's look at this and see how do we use the sales-leaseback approach when accounting. Now remember, it cannot qualify as a finance lease. It has to qualify as an operating lease in order for this approach to work. If it qualifies as a financing lease, we have to use the simple borrowing money that we did back in the other version of this problem. Alright, so with that in mind, right here is the solution to that where we did a note. With that in mind, let's look at how this sales-leaseback would work. So let's pull this into the screen here. To raise operating funds, National Distribution Center sold its office building to an insurance company on January 1st for $920,000 and immediately leased the building back. The operating lease, now that lets us know it's operating so we can follow, but again, the numbers in the last version just didn't make sense, is for the final 14 years. The building has a fair value of $920,000 and a book value of $710,000. Its original cost was $1 million. The rental payments of $96,380 are payable to the insurance company each December. So again, mark through, if you have $220 on yours, it should not be $220, it needs to be $96,380 to create an operating instead of a financing lease. The lease has an implicit rate of 10%. Prepare the appropriate journal entries for National Distribution Center on January 1st and December 31st to record the sale-leaseback and necessary adjusting entries. Alright, since this creates an operating lease, i.e. there's no transfer of ownership, there's no bargain purchase option at the end, the lease term here would be 14 years, but it doesn't give us the fair life, so we assume that it is not a substantial portion of the economic life. And two, when we do the present value of the lease payments, we'll notice that it is only about 78% of the fair value. Therefore, it would not qualify as an actual financing lease, which is what we want. We want it to qualify as an operating lease in order to use this method. All right, so what do we do in that instance? Well, first, we do have to record the sale itself. Okay, so remember they paid $1 million, it has a book value of $710, so they have depreciated this asset because the asset would have been purchased at $1 million, then we would have depreciated it forever how long we've owned it. I don't know how long we have had it in there, so it doesn't really matter. But we do need to record the sale. So what happens when we record the sale? Well, first off, we're going to receive cash, and we're going to receive cash equal to the $920,000. That's what we sold it to them for. Okay, and when we do that, there's a couple of things. When you sell a fixed asset, you have to remove the asset from your books, and you have to remove all of the accumulated depreciation that you would have recorded to date on that asset. And we are assuming that as of January 1st, December 31st would have been our last accrual, so it already has been depreciated to that point. So we would need to get rid of the accumulated depreciation account. Here, we need to find how much. Well, remember we recorded at $1 million. We currently have a book value of $710. So what that tells me is we would have accumulated depreciation of $290, because $1 million minus $290 would give us the $710,000 book value that we would show for this asset as of this date. Okay. The next thing we have to do is get rid of the asset itself. So remember, the building account that we were just talking about has a balance of $1 million in there. So the net of these two has to equal that book value of $710. And then last but not least, we would have a gain. And we would have a gain on a sale-leaseback. Okay, and that would be sort of a plug fee or whatever we'd need to balance out, or $210,000. Another way, you don't just balance out. Notice you had a book value of $710, fair value of $920. So what we got, $920 minus the book value of $710, would give you a gain of $210,000 as well. So I said plug, but you can actually calculate it. It's not a straight plug. So when we sell this, what happens? Well, one, our assets are going down. They're going down by the $1 million, but remember we had depreciated it, so we have to get rid of the $290. So in essence, it's going down by the $710, which is the book value. What else has to happen? Well, we're receiving $920,000, so we're going up by $920. So you could put this as a net. The net impact is $210, which just so happens to equal our gain, right? And then our equity is going up by the $210. So again, here you're receiving cash, but you're removing equipment. So some of this is netting out. So your actual overall impact is our assets are going up by $210,000. Now we do have a gain here. So we would show a gain on our income statement of $210, which would increase our income by $210. Statement of cash flows, we do have a $920,000 cash flow. And this would be from investing. You're like, what? Investing? Yes, investing, because remember, we're selling a long-term fixed asset. When we sell those long-term assets, it is considered investing activity. So this is treated as a sale. Now, once that's done, the next step is we have to record the operating lease. Now, remember, what was the difference between financing and operating? Just how we amortized it. But initially, we still recorded that same right-of-use asset. And that right-of-use asset would be recorded at the present value of the minimum lease payments. And then we would record the lease payable for the same value. So let's talk about that. What happens, or how do we calculate that initial value? So we're going to go in and we're going to do a PV calculation, because that's what we need. We've got an implicit rate of 10%. These are annual payments, so we're good there. Our periods would be for 14 years. Our payment would be $96,380. There is no future value in that beginning or end, and I'm pretty sure it was due at the end. Operating is 14, the benefit value. Payments are payable to insurance each December 31st. So we would have an end. So you could leave it blank, or you could put 0 for end of period. And then hit enter. Notice you get 710 and 1 cent. That's because it's rounded. So let's just keep it at 710. So 710,000. Which happens to equal our book value. But here's the issue with the last one. That payment gave you a book value that far exceeded fair value, so you did have a totally weird situation. So what we got to do is go in and make that where it is truly an operating lease. It just happens to be the book value there. Doesn't have to be, but it does in this case. All right, now once we record it, that asset will sit there until December 31st, or excuse me, that lease will just sit there until December 31st, and on December 31st, we would actually go in and record our first payment. So we'd hit our interest expense. We're going to calculate that same way as before. We would actually take our right-of-use asset. Now in this case, it's just the 710, so we'd multiply that 710 times the 10%, so give us 71,000. That would be our interest expense. Our lease payable is just going to be the difference, and our cash would be the $96,380 that we recorded. So 96,000 minus the 71, so 25,000 will go to the lease payable. All right, so when we do the releases, remember, it does impact our balance sheet. Our assets in this case go up, and our liabilities go up. There is no income statement or cash flows at the inception here because we haven't made a payment. Then December 31st, we make our first payment. Our cash is going to go down 96. Our liabilities down through the lease payable of 25. And then our equity would go down through the interest expense. Interest expense is part of income, so as expenses go up, our income goes down. Statement of cash flows, it is an inflow, or excuse me, an outflow. We're making the payment, sorry, of $96,380. What type of activity? Well, remember this is an operating lease, and operating leases always fall under operating activities. Okay? Now, one other thing that we will have to do at December 31st is we do have to amortize the asset. Now remember, under an operating lease, we want that total expense for the period to equal what would be our rent expense in the old days. So our amortization expense will equal our lease payable. So then when you take the sum of these two and get reported, it just shows that your total rent expense, so to speak, is $96,380. And that's a huge difference between our financing and our operating leases from the leasee standpoint. And that would equal the same. When we record this, of course, our assets go down because we're amortizing that leased asset, and our equity goes down because we're recording amortization expense. Once expenses go up, income goes down. So notice that matching equity and income impact. And there is no cash flow because there's no cash involved in amortization. All right, so hopefully that helps you clarify any of your questions from reading the Sales-Leaseback piece. If you have any questions, let me know. Have a great day.